this is my entire trading strategy on a single whiteboard. The same strategy that made me $92,000 in a single month and on a separate occasion allowed me to make 17.5% in a single trading day. And today I'm going to be sharing you the exact step-by-step building blocks, taking you from zero to the entire strategy on a single whiteboard so that you can also see similar results. So to kick it all off, we're going to be breaking down this word date. A funny word, but you should probably remember it by the end of the video because it is a weird word to remember. Date is going to stand for direction. The A is going to be area of interest. And my favorite part, T, that's going to be for manipulations, or in other words, traps. And then lastly, the point to get in is going to be entry. So this connects together nicely in the form of a date where we're going to be finding which way to be trading, either buying or selling. Then we need to be knowing where we're going to be buying or selling from, the area of interest. The main confirmations are going to come from manipulations. When we see a trap, we know that there is a manipulation in the market. And our job as a trader is not to find an edge. It's rather to catch a ride with the big players. So if I can find a trap in the market, I know when the institutions are interested. And then the last part, E, for my entry, then I just catch a ride with them and make sure I have a pinpoint entry so that I can get a good win rate and a good risk reward at the same time. Okay, now let's break it down. The first step is going to be direction. Now, this is the most important one to build because if you don't get direction correct, then your framework for the rest of the date is going to be incorrect because you don't know the right way to be trading. So everything else you find will be in the wrong orientation. So the purpose of direction now in a market can seem very simple. That is binary. The market can either go up or down. You can either buy or sell. But the reality is going to be a little bit more complicated. The reason being because the market is not so simple, but we can find a simplified approach to break down all the market scenarios into one lens, a common denominator I like to call it. To give you some examples where you can have a higher time frame being bullish. Perfect. Within the higher time frame, you can have a bearish sequence. So then we have two time frames and we have two trends, the higher time frame being bullish and the lower time frame being bearish. So this is still manageable. But when you start to realize inside of this area, it can get a lot more complicated where that bearish sequence that you're having, you might get a sequence of consolidation, you might get a push up and then a spike down. You might then get a bearish spike down and a spike up. So when you realize that there's multiple phases of manipulations, bearish pushes, another manipulation, bullish pushes, it's very hard to get clarity on what is the correct direction of the market because it depends on what time frame you look at. The 1 minute might be one thing, the daily might be another, the intraday might be another narrative, and you could be going through a zone of accumulation, distribution, market cycles. Point being, there's a lot going on. How can we find clarity by taking all of this and knowing how to see direction at a simple glance? So the way that we can do this is by looking at this 3-step approach to find our direction. Now, what I'm trying to achieve is not market structure. I'm not looking for trend because what is trend? We all know what it is. The trend is your friend, but the problem is it can also be very misleading. Now, what trend really is, it's a connection of events. It's not just one push in isolation. It's a sequence of higher highs and higher lows or a sequence of lower highs and lower lows. So therefore, a trend becomes a sequence of events. But when you come to the market on a single day, let's say you open the market today, it doesn't matter what the sequence of events happened before. You're interested in what's happening right now because that's what the most relevant part is. So despite what the higher time frame, the lower time frame, the middle time frames, the accumulations, all of these things, it doesn't matter because we're looking for something else. This is going to be known as the main push. And the main push is going to be done by these 3 categories. So I'm going to show you exactly what a main push is because that's what we're really looking for. Now let me show you some random examples. One, for example, where we have a zone of consolidation and then we see price shoots lower than higher. That's one example. Another one could be just a simple bearish trend. Another one could be just a sequence of higher highs and higher lows. Another one could be an Asia range and then price shoots lower. What we're seeing in all of these scenarios is, yes, there is an explanation of what's happened over here. We could say that this one is an accumulation. We had a build up, we had a spring, we had an expansion. That's Wyckoff theory. Over here, we could see we have a trend line. Over here, we could see we have bullish market structure because of higher highs and higher lows. And then over here, we could see that we have a range and then we have a break test continuation, price goes lower. There's always explanations, but these are always from a lens of a pattern. Describing price once it's already happened, how is that really relevant? What we really need to look for is the common denominator in all of these different approaches, where each one of these is unique, each one of these is different, each one of these has a different name, but they all have the same thing in common, and that is going to be the main push. So the main push is basically looking at the most relevant recent portion with alignment of step 1, which is new territory. So let me show you what it looks like over here, where we have this new push from a low to a high, where we see the previous high was over here and the previous low was over here. So if I draw dotted lines of the previous low and high, we can see that price shot to a new high and price shot through the low to make a new low. So we had new territory found, where we had a previous range, a previous high and previous low. And now we have a new range, a new high and low. Same for this one, where we had a previous high in the market. We had a previous low in the market. We can dot it out and we can see price made a new high and a new low. So we have a new range. Same in this next example where we had a low in the market that led to a high in the market. We draw out the range and we can see that price went on to make a higher low that went on to make a new high. So we pushed out and we made a new high in the market. And this became the relevant low. And same for the last one. Let's say we have this as the last high. This is the last low. Now we have a new lower high that went on to make a new lower low. We dot that out and that becomes the next push. So what I'm finding out over here, that the main push is always from a new territory. So if I find that new push, that new direction, then I know over here that we found a new territory going lower. That means that my main push is bearish. Bearish main push. Over here, we went from a low to a high. So I know it's a bullish main push. Over here, we went from a low to a high in the market, breaking the previous high. So I know it's a bullish main push. And same for this one. We know that we made a lower high that went on to make a lower low. We entered a new bearish territory. We entered lower territory. Therefore, I know it's a bearish main push. So you can start to see, despite all of the complexity in the price action, each one of these examples was a different thing. It was a different name. It was a different strategy. In the end, we found the common denominator. And the best part is it was the most recent and relevant portion. And it gives us a direction. This one being a new bullish main push. This one being a bearish main push. This one being bullish. This one being bearish. And the best part is step number 2, we can identify the range, which is what we just did. We now box off the high of it and the low of it, the high of it and the low of it. This one over here, the low of it and the high of it. And this one over here, the high that made the low. So now we've got two things connected. We've got new main push that has new territory found, a new high or a new low in the market. Then we have the range of it, which is step number 2, identify the range. We just draw a line from the low and the high point. And then the last one is going to be target or relevance. Now, this is where it matters the most because not all main pushes are for us to trade. So it's also going to help you qualify to know which days you trade the market and which days you close your laptop and enjoy your life. So as I'm about to share with you target and relevance of the main push, I don't expect you to take this whole video in one go, the full framework of an entire A+ setup, and understand it right away. And the reason for that is because information is usually not enough. I'm sure you've watched a lot of YouTube videos. I'm sure you've even bought a bunch of courses, yet a lot of traders still struggle after doing so. In fact, what is needed for most traders to tip over from a lot of information towards profitability is implementation. And that's why inside of our community, WWA Trading, we do exactly that. One-on-one coaching, daily live streams for London and New York session, multiple times a week Q&A calls, workshops on the weekend, a vibrant Discord community sharing winning trades and losing trades together, growing together and learning together. We have an environment that is not just designed for information, it's designed for implementation, application, and most importantly, real results, which is why we say transformation. So go ahead and click the link in the description to see exactly what goes on inside of our community and make sure you fill out the application form, and hopefully I see you on the other side on a Zoom call very soon. And here we're going to be looking at overall context. For this one, I'm going to be focusing on example number 3, which was just the bullish trend, a very simple approach. Let's find some clarity on what relevance could look like. So let's take a look at this example of price action where we have a lot of things going on. For example, we have inducement over here, we have inducement over here, we have a trend line over here, a bunch of explanations. But what does it boil down to? We have a low in the market that made a high in the market, that made a higher low in the market, that went on to make a new higher high. So when we mark it out, we can say that this low in the market, this was the low of the range, and this was the new high of the range. So we had a main push bullish. Now we see that this over here was higher than the previous one. So this is a higher low that went on to make a new higher high. Why? Because it broke past the previous high of the range to find a new main push. This is something we already know. It's a bullish trend. We're finding bullish main pushes and we're finding new bullish territory. The next thing I want to do is connect it with context, which is going to be what is the target? Where am I headed? And have I got any resistances on my way? And targets and relevance is going to be around two things. This is going to be counter trends or counter points of interest and liquidity. So let's do that step by step. Let's first talk about counter trends. So what we can see over here is clearly a bullish market. We've got higher highs and higher lows. But what if I zoom out on another time frame and I realize we are actually in a very strong bearish market? And we're right at this low point, and then we started to have this temporary bullish price action. But overall, we are heading back to this supply zone. Then I know, for example, if I've got this bullish market, sure, it might stay bullish, but eventually when I arrive to my supply zone, then it may continue on bearish. So then the relevance becomes, yes, we have a bullish main push. Yes, we do have a temporary bullish market. But overall, if it's bearish based on the higher time frame, then I know I have a destination that I can trade these main pushes until I arrive to my destination, that is a supply zone. Or another factor could be, yes, it's temporarily bearish arriving to this low, but when I do arrive to this low, we are in a hugely powerful demand area. So I know that even though we've got temporary bearish price action, because we're in a demand area, this bullish price action is uncapped until we arrive to a new high in the market or until we arrive to a resistance, meaning supply zone, I'm going to be continually happily buying because I have the relevant context and now I'm in a bullish market coming from a bullish demand area that was relevant. So both of these things are important to be aware of if I've got supply zones that are going to cap me or demand areas that are going to lift me up. And the next thing that I mentioned was liquidity. This can now help us or hinder us. We just need to be aware. So for example, now that I found the main push and it's bullish, from this low to this high, I found a bullish main push and I mark out the high of it and I mark out the low of it, like step 1 and 2. I found new territory because this was the previous high. We found a new high, we made new highs, and therefore it's new territory. Perfect. When I analyze it more closely, I might realize, oh, I've got this trend line over here where I've got 1 touch, 2 touch. Interesting. I've got a build-up of liquidity over here and then a sweep. So this could be a smart money zone. This could be a demand area. And when I do take a look on the left, I realize, oh, I've got this area of resistance where I've got 1 touch, 2 touch, 3 touch, 4 touch. And then when I drag it across, I can realize my current high in the market is also touching that same zone. So I've got an area of liquidity over here. I've got an area of liquidity down here, and I've got an area of demand down here. So I know this can be helpful because I've got a magnet up here because I know price is attracted to the magnet towards this liquidity at the highs. So I know price can shoot up. So that liquidity is going to help me. But let's say in another scenario, I don't have this liquidity up here because these highs don't exist. Now I could say, well, price has a magnet in another place. And this one is a smaller magnet, but it's down here. This trend line liquidity that we have, this is a smaller magnet, but I know it's also relevant because we have this trend line liquidity. I know price can go up, but eventually grab that liquidity in the trend line and maybe even come down to this demand area. So now I've got context that price should go higher because we've got the main push, but maybe it's not ready yet. So I'm going to be combining all of these 3 things together, which is number 1, finding new territory. If I find a push in the market that finds new territory, that is a main push. If I can then identify the range of the high and the low, this is going to help me know the boundaries of the direction I'm looking at. A bullish main push, I know the parameters of that bullish main push based on that range, and then the targets and relevance. I then have a story around it. So I'm not just looking at it blindly, rather I'm looking at the higher time frames to see if it aligns, enhances, or makes things more difficult because there might be a big supply zone blocking me from going higher. And then the liquidity as well. This is going to help me because then I have fuel to help me go higher, or magnets above to help me go higher, or maybe they're missing, or maybe it's pulling price down. All of these things together will connect together to tell a story. And it's all going to give us a better read that is clearer than just simply looking at market structure or a typical top-down analysis. Okay, now that we've nailed down what direction in the market is, now let's move on to the next one, which is area of interest. Now, area of interest is pretty important because when we find a main push in the market and we know it's bullish, that means I know I need to be looking for buys. But it doesn't mean we can look for buys anywhere because you can end up in a lot of false trades, take a lot of unnecessary losses, and don't time the market in a relevant way. So area of interest is going to be telling us where we need to be looking for the direction of the main push. And the best part of this is when you have specific zones, you know that if price is not in your specific zone, you can close your laptop and enjoy your life. Or if it's in your specific zone, that means you know it's game time today. Second of all, is going to obviously remove all of the unnecessary losses outside of these areas of interest. And best of all, is going to maximize your risk to reward and your win rates because you're in specific areas where you know there's confirmation on your side. And second of all, these points of interest allow you to have a very specific stop loss and allow you to have maximum gain. Therefore, you have a positive risk reward at the same time. So let's connect it to the first point, which was direction. So let's say we have that market example we spoke about of a consolidation and then price shot lower and then made a new high. Perfect. When we find this, we have now identified a main push where we had a low in the market that made a new high in the market that broke past the previous high in the market. Therefore, we have successfully found a bullish main push in the market. So with that in mind, I can now plot out the high of that range and the low of that range. That was step 2 of the main push. And step 3 of the main push was relevance. Let's say here we have arrived to a demand area on the higher time frame. So we know we're in a bullish demand area and then we've made a bullish main push. So now we've got new territory found. We found the range of the high and low of the main push, and we found the relevance that we're in a bullish market on the higher time frame. Perfect. Step number 1 of direction, check. Now, area of interest. So when we look inside this main push, well, it's unlikely price is just going to shoot up in one line. That's not how price moves. Inside of this area, if we were to look closely, we might see price comes lower into the zone and then pushes higher, consolidates, price moves in this gradual fashion. And then we arrive to this previous high in the market. Now, let's say price does one final retracement, prints this equal low, shoots lower, and then shoots higher. Perfect. And then we keep going. And then eventually we make the higher high. So yes, price did go from point A to point B. It did make that main push, but we can see there's a lot of details in here, not just sequence of higher highs and higher lows, but we want to read every detail. The details here is number 1, we have equal lows and then we have a sweep lower to be a inducement. Perfect. We see that this was the previous high in the market. So we know we had a break of structure over here, and then we have the ultimate higher high in the market, the main push that made the higher high. So when I connect all of these things together, this helps me define my points of interest now even better. The first point of interest is always going to be my extreme. The extreme is just where point A is. The lowest point that started the move, that is our extreme. So I can just draw that off and say this is my extreme demand. Now this is just step one of finding the area of interest. I'm going to show you in a moment how to refine them, how to qualify them, and how to optimize them. But first, let's find these areas. And the next one is going to be, this is where you need to probably take notes, is this last pullback before the break of structure. So let's say that again. It's as price was coming higher and lower, and then we had the final bearish portion before this previous high in the market was broke to form the new high. So when we had the last pullback before the push higher to make not only just a higher high internally, but we broke past the previous high in the market to have this break of structure. This area, the last pullback before a break of structure, this is known as our decisional point of interest. So now there's plenty of places we could be attracted to. We could say there's a trend line over here. We could find a random support level later on. We could find breakout trades. We could find order blocks. There's so many ways to enter the market. It can get very overwhelming, especially if you start using indicators, RSIs, EMAs. There's so many ways to enter the market, to be interested in the market. And that's why so many people get it wrong, because whatever strategy you use, if you mix and combine, you will always have an area or an interesting place to get into the market. The problem is, and the reality is, what I always say on this channel, and my motto is a restricted trader is a profitable trader. The reason being is that we don't need more winning trades. For you to find profitability, it's not about finding more winning trades. We can all take a winning trade. That's not the hard part. The hard part is avoiding losses. That means when you take a winning trade, you don't give it all back in the next 5 trades to the market. This is what a restricted trader is a profitable trader means. So if we can now eliminate all of those random areas you could get in and focus on just number 1 and number 2. 2 simple areas that are easy to find in the market, that are relevant, that have a positive expectancy. These are the areas to focus on because it's going to be restricted. Yes, you're not going to be able to take a random trade that goes from here. That's okay. That's not our trade. But the places we do get in, we are restricted, we have a positive win rate, and we have a great risk reward profile because I don't need to enter over here with a stop loss at the low or any random strategy that people use. We have a tight zone of a specific area of a decisional and extreme. And within here, when we find confirmation, very tight stop loss with wisdom and logic on our side because it's an area of impact. It's a decisional that broke structure. That means I know that there's buyers in this area. That's why it has a better win rate, and it can ultimately lead to me trading all the way back to the new high. That's why it has a great risk reward at the same time. So now that we've identified what a decisional and an extreme is, these are the 2 areas I need to be focusing on inside of the main push. So this is what we do. So what we do is we find the previous high in the market and the previous low in the market. We see that a new low was formed that went on to make a new high in this case. So we found a bullish main push. Once I found that bullish main push, I just find the extreme over here and the last retracement before the new high was made, breaking past the previous high. That is the decisional area. And now I just have 2 simple areas to focus on. My 2 areas of interest, a decisional and an extreme. Perfect. Now to qualify them and improve them and refine them, what do I need to do? This is where I follow another step-by-step plan. What I'm going to be looking for is these 3 things inside of my points of interest: an inducement, an imbalance, and a break of structure. If I can find these 3 things, I can find a refined area, not just a large demand block, rather a 10 pip range, perfect for points of interest because it's precise, it's relevant, and it's also going to avoid us getting in at a large block. You can get in at any point. So you can get in randomly, you can get in the false move, you can get in on early traps, and you're going to be confused half the time because if you have a 50-point area of interest, that's a huge zone. There's always going to be an opportunity to get in on such large areas. But if you have a 10 pip zone, it's refined, it's polished, and it's optimized because it has these 3 things inside of them. So when I look inside a points of interest, for example, this demand area down here, the extreme demand that we just spoke about, inside of it, it can look like this, where price goes lower and then price goes higher. So how can that present on the M1? Let's say on the M1 or M5, we see price goes lower and then we just see price goes higher. Is that telling us a lot of things? Not really. It's just telling us price went lower and then price went higher. Where's the details? Where's the information? Where's the control? Where's the institutions? We don't see anything. So then what you end up doing is just taking a large block and you say, okay, the high of that zone, the low of that zone, that's going to be my demand area. And that's when you end up with a zone that is a 50 pip area of interest. A huge zone. And then the first time price taps into it, you get into a buy, it fails. You get into the lower zone, you buy, it fails again. And then you get in last and then it maybe fails ultimately. You take unnecessary losses because you don't know where was the precise area and where the institutional control was. In this case, there was no institutional control, maybe an area to avoid. But now let's say I see the same area of price action. If I look closely on M1, what if I see something different? What if I now see the price went lower into that lower low? With a consolidation, we formed lows. Then we swept lower aggressively and we took out that liquidity. And then after that, we shot higher. Perfect. Now I have a lot of information. I have a lot of details. Number one is going to be, okay, if we have a inducement over here, who does inducements? Who can break this support level? Not the regular person, not a retail person. Only institutions have enough volume to take the market, to move it from a support level to break lower, take all the stop losses, and then move it higher. This is an institutionally funded move, and this is relevant. So now instead of looking at the overall block, which is a 50 pip zone, I know I can be interested around this inducement, but that's still not precise enough. All I can confirm with this is that there's institutional intent here. So it's a real demand area, not a fake one or not a weak one. Once I've done that, I need to take an analysis of what happened in that inducement. And what that's going to look like is, let's say we have candle number 1 is bearish over here. Candle number 2 is bearish. And then candle number 3 is neutral. Now after that, I start to see the bullish move up and I see large bullish candles going after that. So for example, let's say candle number 4 is a large bullish candle and candle number 5 is even larger, bullish candle. And this is telling me that not only did price go lower, then go higher. It's not about that. It's about the read inside, where I see that candle number 3, 4, and 5 was telling me an important story. And that is the range of candle number 3, the high and the low, and the high and low of candle number 5 over here. We see that there's a large gap in between. In the region of candle number 4, this area where I'm shading in purple, this is my imbalance zone. Why is an imbalance interesting to me? Because the high of candle number 3 and the low of candle number 5 with a large engulfing bullish candle number 4, this is showing me momentum. This is showing me power. This is showing me movement in the market. And if I can see that that movement originated from an inducement, now I'm connecting two things together. I'm seeing institutional intent and institutional reaction. If I can see both of these things together, this is telling me this is a real demand area. This is an area to focus on. And then the last step, which is the BOS, if I can now see the lower high that made the lower low now goes on to make a higher high, then I'm seeing a clear lower low to higher high scenario. This is a break of structure. And when I see that break of structure, this confirms it to me that this is a real important demand area. And now I know where to focus on, which is number 3. Now I can just take candle number 3 as my demand area, as opposed to previously the entire block that is 50 pips. Now we can focus on a 5-minute or 15-minute candle. You make sure you write that down. 5 to 15 minute candle, candle number 3. The indecision candle, that was an inducement candle before the imbalance. So the imbalance confirms the zone and the low of candle number 3 confirms the zone. That is how we find our refined and confirmed demand areas. So in this case, instead of me focusing on this large 50 pip area, now I can find the refined candle number 3, and maybe this one on the M5 or M15 is going to be 10 pips. So now I know all of these areas where price may be chopping around is tricking us to get in. We are not interested in, because we are not focusing on the overall demand. We're focusing on the refined area. So instead of a 50 pip zone, we have a 10 pip zone of relevance. So when price chops around and traps people in, doesn't matter. But when it comes to our area, we now need to be interested, because the area of interest is just refined and optimized. And then the next step is going to be seeing how we can see traps and entries. Okay, now that we've completed how to find an area of interest correctly with refinement, now we're connecting a lot of things together. We've got the main push, and we know, for example, in this case is bullish. Then we have the area of interest. We know where to be looking for buys in this bullish trend or this bullish impulse. The next thing is going to be my favorite one that a lot of people don't even know about or talk about, and this is manipulations and traps. But the logic that we mentioned earlier, if we don't see the trap and manipulation, then where are the institutions? Because the institutions are the only ones that have the liquidity, power, and capability to trap people in the market, to engineer price, to trick people to get in and take them out. An inducement and a trap is very powerful because it tells me when the institutions are active. And our job is not to predict the market, is not to guess where it's going to go, it's to react when the big players are getting in. We catch a ride alongside them. So in other words, my favorite word in trading is going to be inducement. When I can find traps or inducements in the market, this is where I know now that price is getting ready for an opportunity. It's not just coming into a zone, it's coming into a zone prepared with institutional intent behind it. And the logic behind this being that, of course, there's a lot of strategies, a lot of ways of trading, there's a lot of schools of thought, and a lot of them are very well documented. There's books about it, there's YouTube videos about it. So how can this be misleading? Well, let me ask you a question. Isn't it a known statistic that 95% of traders in prop firms and in brokerages fail? So if 95% of traders trade in a very similar way, they trade these famous things like smart money concepts, supply and demand, market structure, Support and resistance trend lines, EMAs, all of these things, Fibonacci's, the list goes on. Everybody knows about it. This is nothing special. And if 95% of traders trade in the same way and 95% of traders lose, that means that there is an issue in the way that most people trade. Now, before alarm bells go off, let me say one thing, and that is that a lot of strategies work, but they work sometimes, and that's the issue. They only work sometimes, just like a broken clock. At 6 o'clock, it's correct. At 6 a.m., 6 p.m., twice a day is correct. The rest of the day is wrong because it's a broken clock. That's the same fashion with a lot of strategies where a majority of the time they are wrong, but sometimes they do work. And the fact that they work sometimes is when people go and back test, and in hindsight, they see and cherry pick those scenarios and say, yes, this strategy works. But in the reality of day-to-day trading, it leads to a lot of failure. So we need to understand what's going on here and how we can actually take advantage of it instead of falling for these traps. So traps, there's going to be plenty of videos in this channel, and it's a long topic that I've done multiple case studies and breakdowns on. So what I want to focus on today is one of my favorite ones, and that's going to be a smart money trap. When smart money traders get into the market and then they get manipulated out. So what's that typically going to look like is, first of all, a specific range, a typical support level. It could be an Asia range. It could be a equal lows. It could be a double bottom in a demand area. I'm just looking for a clear equal lows or area of resistance. And this is what smart money traders are going to be interested in because they say that the stop losses are going to be in this area. Perfect. Because we know supports and resistance is a very outdated approach. And yes, it's become targeted. So the smart money traders think they're one step ahead. They're going to wait for the smart money sweep and they're going to wait for a reaction higher. So then that leaves a zone for smart money traders to get in, a smart money zone. And that's going to be a smart money demand area, a sweep zone. And this is where this order block is going to be placed and where smart money traders are going to be getting in and their stop losses are going to be right below this sweep. So when I see this pattern, there's going to be a sequence of invalidations for me. For example, if this happens at Frankfurt Open, if this happens around Asia high or Asia low, if this low happens at a lower low in a bearish market, there's going to be a trap. Or if I get an efficiency of the pullback, that price hits the supply zone right after the sweep. These are my invalidations of why I wouldn't take a trade like this. And therefore, I know that this is more likely to be a smart money trap. So instead of price going higher like the smart money traders would want, I wait for price to come into the smart money zone, react a bit, invite the buyers in, show them the trend line, show them the price action that they want, and then shoot lower. Once price is shot lower, not only did we take the liquidity of the support resistance traders, we also take the liquidity of the smart money traders. Once that has happened, then this could be the real inducement. And if I thereafter see a real move with the same confirmations, if I see an engulfing and an imbalance, if I see a break of structure and reaction, then I know this is most likely a manipulation and a trap specifically targeting smart money traders because there's a lot of crowded price action. There's a lot of orders, smart money liquidity, stop losses in this area. And if they get swept, then this was an engineered price action moment. And I know that only the institutions could have taken their liquidity and then arrived price higher anyway. So obviously there's many forms of inducements, but this is specifically what I'm looking for. When I found my main push and it's bullish, and then I found the bullish area of interest, my extreme and decisional demand, and then I find a form of a trap and manipulation. For example, a smart money trap. It could be a head and shoulder trap. It could be a Fibonacci trap. It could be a trend line trap, support and resistance trap. There's many types of traps in the market. This is something worth learning and studying. But if I find one of them, for example, my preferred one being a smart money trap, now I know that the institutions are getting into the market in my area of interest in the direction of my main push. I'm connecting everything together now. And therefore the last portion becomes when I've connected my inducement or trap is then to find my execution, is to find the entry. And to find the entry is a very simple protocol. I have a list of about 10 entry protocol types, but my favorite one of them I'm going to share with you today. And I'm going to bring it in together with my famous trinity. The three things that I always need for any trade is going to be inducement, then it's going to be lower time frame confirmation, and the last one is going to be time window. If I see these three things together with the whole setup ready, then this becomes a very high quality setup for me with high win rates, high risk to reward, and with the trade management sequences and risk management sequences that I share, it's a road that is well on the way towards profitability and something that I've been utilizing for years now. So let's break down the entry, the last portion. So once I found my trap, let's say I have a bullish main push and I found a relevant demand area. Then price comes during Asia range and forms an Asia high, Asia low consolidation. And after that, price shoots lower. But the problem is price is shooting lower and then reacting higher, but it's happening during Frankfurt Open. The problem is this sweep is happening at Frankfurt Open. Frankfurt Open is a trap time for me. If a sweep happens at Frankfurt Open, this is more likely a manipulation. This is more likely a smart money trap. And therefore I know that this is an area that is more likely to be manipulated. A smart money concepts trap. And therefore I know I'm actually loaded up for a potential good setup, because if I know that price can in Frankfurt session come into that smart money trap zone, invite in buyers and then sweep them out, and then also arrive to my demand area. Now I'm getting everything that I needed. I've got the main push that I wanted. I've got the demand area refined as I needed. Then I have a smart money trap presenting because of the Frankfurt Open sweep time. And then as I arrive to London Open, this is the key. The open of that session, if I can now get my lower time frame confirmation, then I have the Trinity. I have an inducement that's happened, the smart money trap inducement. I've got lower time frame confirmations that I'm waiting for, and I've got time on my side. It's a key window and it's in a refined demand area, and I'm trading with the trend of the main push, not overall trend. Now I've got a sequence of steps that is very powerful. And if I get one of my favorite lower time frame confirmation types, for example, we could have a bearish market turn into a bullish market. That's going to be a very easy lower time frame confirmation where we have lower high, lower low, lower high, lower low, and then price goes on to make a higher high, and then we find a refined IFC to enter on to make a higher low to then find the new higher high. That is a very powerful entry type and one of my favorites. It's known as the break of structure on M1, where I enter upon the right refined IFC and stop loss at the low, typically being 3 to 7 pips stop loss. This now takes a 50 pip zone to a refined 10 pip zone, as we spoke about earlier, to then a refined entry of 3 to 7 pips. That means, for example, on a euro dollar, on an average movement of 20 pips in the London session with a 3 pip stop loss or a 4 pip stop loss or a 5 pip stop loss, I can get a 1 to 3 risk to reward in a single session. So I can get a high win rate, precise entry with a high risk reward profile in a short amount of time. Another preferred entry type of mine is going to be known as a 2-leg protocol, where price shoots lower in the inducement as we have over here, price shot lower, and then I start to get one leg. Instead of going to make a lower low as you would expect, because right now it's bearish, we fail to make a lower low, we don't make a lower low, and we go on to make an internal higher high. Once I see that shift of failing to make a lower low and actually making a higher high, now I have 2 legs on my side, the first leg and the second leg, and then that becomes my opportunity to enter over here on the second leg. This becomes my entry, and the stop loss can go at the low as well. That once again leads to about 3 to 7 pips stop loss, and that becomes the 2-leg protocol entry, where we have price makes a lower high, shoots lower to make a lower low, makes an internal high, a higher low, higher high, 2-leg protocol. I get in over here on the refined IFC and I look to trade it higher. Same thing once again. The key being, if this happens in my London Open, I can now trade it towards, for example, the Asia high liquidity. And if it's a higher time frame demand area, then I know it could go on and on to make a new higher high. This is how you connect everything together. So we did it on a single page. We have broken down this word DATE. DATE, an acronym for direction, area, traps, and entry. Together breaking down each sequence of it to formulate what is usually going to be an A+ setup, high win rate, high risk reward, high trade frequency, and most importantly, you're not sitting in drawdown for days because you're in and out within the space of a few hours. So go ahead and check the rest of this channel to see more of these in action, where I have case studies, scenarios, chart examples, and many more things breaking down this framework of DATE. And as always, a restricted trader is a profitable trader.